Yet another down day in the stock market as pressure begins to mount on the Federal Reserve and their rate rises. They are still nowhere near the level they said they would be at, but nevertheless, they are already constraining the financial system. Money is still cheap by historical standards, but apparently this has already gone too far. What will the Fed do? You came here for the truth, so let me unveil that for you. Today we're going to look at the Federal Reserve, we're going to look at US stocks, we're going to talk about tech stocks, I want to talk about the IMF, I want to talk about gasoline, and so much more. Let's begin by taking a look at this article out of CNBC. Dow drops 400 points as October rout continues. Tech stocks lead the slide. You saw the FANG stocks in particular, money flowing in, and it was unlimited, and tech stocks were the new best thing, and it could never go down, and suddenly we have a problem. So let's get into this here. Rising rate fears and a pivot out of technology stocks have made it a rough last few days. The S&P 500 is down for 5 straight days. The Dow dropped 4 out of the last 5 sessions, losing about 700 points of that span. Now, this is coming at a time where a lot of people have not been preparing accordingly. They have been going for absolute growth, and they've been doing so because they are following in line. The central banks act first. Then you have the institutional investors. Then you have the little minnows chasing the bigger fish. That is the retail investors. So here you could see that this has been a problem because a lot of people weren't making the necessary preparations. I'll get into that more in a second. Shares of Amazon declined more than 3%, Netflix 5.8%, and Facebook and Apple down more than 1.5%. Okay, so we have significant declines here in the short term. But of course, need to mention it every time, we have the case of these stocks doing very well all throughout 2017 and for the majority of 2018. All right, so that needs to be mentioned. You drop 3% or 6%, it's still up significantly from where we were previously. Okay, that needs to be understood. People are getting out of the high-flying tech names right now. I think people are underhedged and there could be more pain ahead. Clearly, this is something I've talked about all the time, where people are simply chasing the growth and they are investing in the FANG stocks in particular. That's where all the money had been fleeing to because that's the only thing that was going up. So now what people are starting to do is selling off, they're taking profits and they're putting them into what they believe to be more secure and sturdy stocks. And they're doing so because they want to be able to hold on to some of that value, and this is going to start to perhaps rebalance individuals' portfolios. It's not going to be done at the retail level. People don't do that at the retail. They go all in, but the institutional investors may decide to, make some changes to their portfolios, to say the least. All right, now one of the stocks that isn't part of the FANG stocks, but it's certainly a tech stock, and it's been talked about ever since the IPO as being a pump and dump. Snap falls to new low after media analyst says the company is quickly running out of money. Now, I can't say what's going on behind the scenes at this. We can only look at the financials, and we need to address it for what this is. This is an idea. This is an app. This is a way for people to connect and see information, and the valuation became ridiculous and absurd. But this is what happens. With these tech stocks, there's too much hot money flowing in, trying to find the next Facebook, trying to find the next Instagram, trying to find the next billion-dollar idea. Sometimes it works, sometimes you get screwed over, and unfortunately for Snapchat, it doesn't look very promising. Now we're talking about the IMF, and we have the real economy to worry about, because you can look at the stocks and you can see what quantitative easing has done, and it is important, no doubt, but we need to also be looking at the actual real economy. A severe recession would slash U.S. public wealth by about $5 trillion, causing vastly more damage to Washington's finances than just an increase in debt and deficits. That's according to the IMF. They're talking about the details, which I covered actually recently, talking about the IMF. I showed you where you can download the report that they're most likely referring to in this website here. But all I wanted to really talk about was the fact that the IMF sees the problems, and I don't like their solutions obviously, but their reports are always very good, very detailed, and very thorough in really highlighting the risks. Okay, so that's really what I wanted to then look at for the next point. We have many companies today that were staples, household names not that long ago, and suddenly they're becoming worthless. And Sears is one of those. They're preparing to go into bankruptcy. They have closed so many stores along with Kmart and Macy's and JCPenney and all these other big box stores, all these other brand name stores that are simply going the way of the dodo bird. I mean, they're getting out of there, and this is really an issue because of a lot of people that are losing their jobs. A lot of people are not going to be able to get that paycheck anymore, and they're going to have to take on temporary work. They're going to have to take on 2 jobs. They're going to have to take on 3 jobs in some cases, and this really shows us what's going on today in the real economy, that you have major store closures being replaced by very low wage salaries, by temporary workers. They're being replaced by eventually robots and automation. That is the goal. And they're getting rid of, they had pension funds perhaps. They had maybe some sort of 401k type plan. Those are all gone. The days of those are going to be over, all right? National gas price comparison. But I just wanted to show you really what we're looking at today, and it is incredibly expensive, and you could see that $291 looking at this in the United States, but this is nothing compared to what we see all around the world. In Canada, it's extremely expensive for the most part, and when people tell me what they pay in many European countries, it's just crazy. I don't even know how people afford it, really. It's unbelievable how expensive gas can be. I mean, that is how you're getting around from point A to point B. If suddenly your job is so expensive to get to, people need to start moving closer into the cities. Maybe that's what they want. Maybe they want more control and oversight. On the left-hand side, you could see the daily mortgage rates. 30-year mortgage, 5%. That's big. I mean, we're talking about 30-year mortgage at 5%. The 5% mark is not just psychologically, but I believe it is also going to be a backbreaker for many. Look at this. You can see that in a chart form what has happened. We're going back into levels not since the financial crisis. So this is truly worrisome for a lot of individuals who are taking on variable mortgage rates as well as trying to get into a new home. I think it's going to cause a big slowdown right now in the US economy when you look at this, not just in terms of the housing itself, but how, if mortgage rates are going up, that means interest rates on credit cards, personal line of credits, consumer loans, everything else, everything that's attached to all of this is going to be slower, no doubt about that. 0% financing deals fade from the new car lot as interest rates rise. So it's not just going on, as I said, with mortgages. This is also following along with every other market, and that is worrisome for all of these different businesses. All right, so whether it's cars, whether it's homes, whether it's just the banks and the financial industry, they're all going to be suffering as a result of rate increases. Now, just to be very clear, I want them to increase interest rates. I want them to actually fix the underlying issues that are never ever being presented to the public. I want them to just fix them once and for all. This right here, it's basically the central bank assets, and we're looking at the G4 plus the Swiss, but I've shown you many before. I've shown you the G3, the G5, and so on. Looking at this, it worries me a lot because we know what's coming, and we look at this to understand the truth. When you see the central bank assets are actually in a decline, that is going to be a very big problem for stocks and for all of the different markets which have been benefiting from the quantitative easing. This goes for any country right now, I mean, even Japan is starting to print less money than they were before. Can you believe it? I don't know how they're getting away with it, but their market is going to take a beating as a result. There's no doubt about that. They are completely and entirely reliant on central bank monetary easing, and here we go. It's starting to decrease. So let's see where this goes into the future. I'm going to end the video there. If you found it informative, please give me a thumbs up. When you give me a thumbs up, it helps us support the channel, so I do appreciate that very much. And last but not least, if you want the financial education that was not taught to you in schools, well then you got to read these 2 books. These 2 books are going to explain everything you need to know from A to Z. You can check them out at the link in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.